For generations, we were taught one simple rule about money: the safest place to keep it is in the bank. It feels like a law of nature, doesn't it? Save your money, put it in the bank, and sleep soundly. But what if that's not the full story anymore? What if the very system we were told to trust is showing some serious cracks? Around the world, a quiet distrust is growing, and the smartest money is starting to look for an exit. What if they're moving to a new kind of bank? One that isn't run by people in suits, but by incorruptible software. This isn't just a wild idea, it's a shift that's already happening. And for your own financial future, you need to understand why. The entire story of modern money boils down to one word: trust. We trust the bank to hold our money. We trust them to give it back when we ask, and we trust that its value will still be there tomorrow. But what happens when that trust gets shattered? For many of us, the wake up call was 2008. The global financial crisis wasn't just a market crash. It was a catastrophic failure of the system we were all told to believe in. It all started with reckless gambling in the housing market, creating a bubble that was destined to pop. And when it did, it didn't just hurt Wall Street, it wrecked the global economy. So, think about that. The very institutions we trusted with our savings were making bets so risky they nearly burned the whole house down. And the solution? Bailouts. The government used taxpayer money, your money, to save the banks that failed. It sent a loud, clear message. The rules are different for them. That moment planted a seed of doubt, the nagging feeling that maybe the system isn't designed to protect us, but to protect itself. This wasn't just some historical event, it was a turning point. It exposed deep, fundamental flaws in how traditional finance really works. The tremors from 2008 are still felt today, but the problems have taken on new forms. The cracks in the system haven't been fixed, they've just gotten wider. Right now, leaving your money in a bank account comes with a new set of risks that are quietly eating you alive. First, there's the slow, silent killer, inflation. To keep economies afloat, central banks have been printing money at an incredible rate. The result? The cash you're so carefully saving is losing its buying power day after day. Everything is getting more expensive, yet the interest you earn in a typical savings account is almost a joke. As of October 2025, the average savings account in the US yields just 0.40% APY. Let that sink in. Your bank pays you a fraction of a percent while the real value of your money shrinks. It's like trying to fill a bucket with a slow leak. You think you're saving, but you're actually losing ground. You're not building wealth, you're just managing a slow motion decline. Then there's the stability of the banks themselves. Our system is built on something called fractional reserve banking. This means when you deposit your money, the bank doesn't just store it, it loans out most of it. They only keep a small fraction on hand. This system works until it doesn't. We saw what happens when it breaks in 2023 with a string of bank failures that were the largest since 2008. Banks like Silicon Valley Bank and First Republic didn't just have a bad day, they collapsed due to fundamental mismanagement and a sudden panic from depositors. In the case of SVB, a classic bank run was triggered after it had to sell its assets at a huge loss, making everyone realize the bank might not have the money. These failures weren't just one offs, they were a brutal reminder that the system is fragile. And while government programs like FDIC insurance do protect deposits up to $250,000, these events shake our core confidence. The fact that they can happen at all shows the foundation isn't as solid as we thought. Beyond the financial risks, there's a growing concern about control. While most of our day to day transactions go through just fine, there's a growing unease about financial surveillance. Transactions are monitored and in some countries even blocked. The reality is your money in the bank isn't yours to control without some level of oversight. You have a claim on it, but you don't have the final say. For many, that loss of financial privacy is a price they're no longer willing to pay. So, where does that leave us? With a system where your savings are losing value, the institutions holding them are brittle, and your control over your own money is slipping. The promise of the bank as a safe haven is starting to look pretty thin. Right as the dust was settling from the 2008 meltdown, something incredible happened. On Halloween of 2008, a mysterious anonymous figure known only as Satoshi Nakamoto published a 9-page paper to a small group of cryptographers. The title was simple: Bitcoin, a peer-to-peer electronic cash system. This wasn't just another academic paper, it was a direct answer to the crisis. It proposed something that sounded impossible, a financial system that didn't need banks, governments, or any middlemen at all. Satoshi's motivation couldn't have been clearer. Embedded in the very first block of the Bitcoin network is a hidden message. It's a headline from a London newspaper from January 3rd, 2009, Chancellor on brink of second bailout for banks. It was a permanent digital declaration of independence from a broken system. Satoshi wasn't just trying to create a new form of digital money, they were trying to solve the problem of trust and human fallibility. The genius was in combining existing technologies in a brand new way to create something that functioned like digital gold. For centuries, gold was our best bet for storing value outside of anyone's control. It's rare, it's durable, and you can't just print more of it. But gold is physical. It's heavy, hard to move, and you can't exactly email a gold bar to someone across the world. Satoshi created a weightless digital asset that had the properties of gold, but was built for the internet. An asset you could send anywhere in the world to anyone almost instantly without asking for permission. To do this, they designed a system with a fixed, predictable supply. There will only ever be 21 million Bitcoin. That's it. This rule is baked into the software's DNA. It can't be changed by a CEO or a government. While the protocol could theoretically be changed with overwhelming community consensus, for a rule this fundamental, it's practically impossible. Unlike our money, which can be printed endlessly, Bitcoin's supply is absolutely finite. Its inflation rate is transparent and programmed to fall over time, eventually hitting zero. This was more than a tech breakthrough. It was a philosophical one. It was the invention of a new kind of savings technology, a bank in cyberspace run not by people, but by math. A system where everyone knows the rules and no single person can change them. So, how can a bank in cyberspace work with nobody in charge? The magic is in its architecture, the blockchain, decentralization, and a process called proof of work. Let's start with the blockchain. Picture a massive public ledger, a digital record book. Every single transaction is recorded in this book, but instead of being stored on one central server at a bank, thousands of copies of this ledger are shared across a global network of computers. That's decentralization. When you make a transaction, it's broadcast to this network. Computers called miners then compete in a global competition to be the next bookkeeper. To win, they have to solve a complex mathematical puzzle. This process is called proof of work. It requires a ton of computing power and energy, and that serves two key purposes. First, it secures the network. To cheat and alter a past transaction, an attacker would have to redo all the math for that block and every single block that came after it, all while outpacing the entire global network. The cost would be astronomical, making the ledger practically unchangeable. The history is set in stone. Second, it's how new Bitcoin are made. The miner who solves the puzzle and adds the next page to the ledger gets rewarded with a set amount of new Bitcoin. This is the only way new coins are created, and that reward gets cut in half about every 4 years, an event known as the halving. This predictable slowdown in supply is what makes Bitcoin's value proposition so powerful over the long term. Think about what this means. There's no central authority. The network validates itself through math and proof, not trust. You don't have to trust a person, you just have to trust the code, which is open source for anyone to check. This is what makes it incorruptible. It doesn't rely on human integrity. It's a system that's incredibly difficult to shut down. A government can't just unplug a central server because there isn't one. They can and do try to restrict access, but the network itself just keeps running. Satoshi designed Bitcoin to be as reliable as the laws of physics. Just as we can rely on gravity, users can rely on Bitcoin's 10-minute transaction blocks and its absolute supply cap of 21 million coins. That predictability is the bedrock of its use as a savings technology, a stable island in a sea of financial uncertainty. Maybe the most profound part of all of this is the idea of true ownership. When your money is in a bank, you don't actually own it. You own an IOU, a promise from the bank that they owe you that money. The money is technically their liability. And as we've seen, sometimes promises get broken. Bitcoin flips this completely. You don't need a promise. You hold the asset yourself. This is possible thanks to something called public and private key cryptography. Here's how it works. You have a public address, which is like your account number that you can share freely, but you also have a private key, a secret piece of code that you keep to yourself. That private key is what authorizes you to spend your funds. Whoever holds the private key controls the money. End of story. This is what being your own bank truly means. As long as you protect that private key, no one on earth can touch your funds. Not a bank, not a corporation, not a government. For the first time, we have a digital asset that you can truly personally own without anyone else's permission. That's a massive shift in power from large institutions to the individual. It grants you financial sovereignty. For the billions of people in the world without access to banks, it's a gateway to a global financial system. For people living under unstable governments, it's a way to protect their wealth from being seized. And for those of us in developed countries, it's an escape hatch. It's a way to hold a piece of your wealth completely outside of a traditional system that is devaluing your savings and chipping away at your freedoms. This isn't just about speculating, it's about saving. It's about preserving the value of your hard work over the long run in an asset that nobody can create more of or take away from you. So, is this still just a playground for tech geeks and rebels? Not anymore. The smartest money in the world is finally taking this seriously. Institutional investors, the giant hedge funds, asset managers, and family offices that control trillions of dollars are done laughing. The conversation in high finance has completely changed. A few years ago, they were critics. Now they see it as a legitimate asset. Why the change of heart? Because they see it as a hedge, a form of insurance against inflation and the very systemic risks we've been talking about. They see an asset that is digital, scarce, decentralized, and sovereign. The launch of regulated investment products like Bitcoin ETFs has given them a safe and easy way to get exposure, and governments around the world are slowly but surely creating clearer rules for the industry. In 2025, the debate on Wall Street is no longer if digital assets will be part of the future, but how big a part they will play. Sophisticated investors aren't chasing quick flips. They're playing the long game. They understand that in a world drowning in debt, an asset with a fixed supply is the ultimate lifeboat. They see the cracks in the old building and are quietly moving a portion of their wealth into a new one built on code, not on confidence. We started with a simple idea that the bank might not be the safest place for your money anymore. We've walked through the trust that was broken in 2008, the slow bleed of inflation, and the constant risk of institutional failure. We've seen how a system run by flawed humans is, by its very nature, fragile. But we've also discovered an alternative, a path created in response to those very flaws, a savings technology for the 21st century, a bank in cyberspace run by incorruptible code where the rules are fixed and fair, a system that gives us back something we lost, true ownership. This isn't a call to abandon the old system entirely. It's a call to open your eyes, to understand the risks you're unknowingly taking, and to recognize that a powerful choice now exists. The smart money is already making its move, not to gamble, but to preserve. The world is changing. Money is changing. The only question left is, will you? What are your biggest worries about the traditional banking system? Do you think technologies like Bitcoin are the answer? Drop your thoughts in the comments below. I read every single one. And if you got value from this breakdown, do me a favor and subscribe. We're just getting started.